Hey, mortgage rates go up. Fixed mortgage rates are all going up this week. By the end of next week, every major bank, every kind of lender, fixed rates will be up. So up from where to where? So we had a bunch of rates in the fours, which were mainly all high ratio rates. That's the CMHC insured rates. We had it as low as 5.69, 5-year CMHC purchase fixed mortgage. Very specific. This very specific product, but 3-year was below 5. We had lots of 4.99 3-year, 4.84 3-year, lots of it. Okay, so what the hell happened? It's all going up. Everything will be over 5 or 4.99 at the very best, but almost everything will be over 5. Even some mortgage rates that had fallen to like 5.09, 5.19, they'll be back up closer to 5.49. So why the jump? Why are we going to experience about a 30 to 40 basis point jump just in this brief period of time? So what happened? Again, this is fixed rates only fixed rates, not variable, not any rate that's governed by the Bank of Canada, because the Bank of Canada hasn't done a thing. Haven't gone up, haven't gone down, stayed the same. So HELOCs, variable rate mortgages, everything status quo, no change. What happened? Well, in previous videos, we've talked about the fact that the bond yields, Canada bond yields, the Government of Canada bond yields govern the pricing of fixed rate mortgages in this country. And a number of things happened all at once to radically impact on these bond yields. Now, wait a second, you say, wait a second, Ron. You said rates would come down. You said eventually the Bank of Canada would cut. Yeah, sometime this year, the Bank of Canada will cut. Sometime this year, rates will continue their downward trend. But I said 100 times, it's not linear. It's bumpy. There's ups and downs along the way until you eventually arrive at the end of lower rates for a longer period of time. What hit us? What happened that punched all these bond yields up and is now punching up all these fixed rate mortgages? Couple of things. First of all, we had like a disastrous equity market day all across North America. Oh my God, every market was in the crapper on Tuesday, just totally in the crapper. And when money is flying out of the stock market because people are selling stock, then that money at least 50% of it's institutional, so it just moves. It has to have some place to go. So in many cases, just moves into bonds, and bonds buying brings yields down. Bond buying pushes yields up. You buy, it goes up. So other things were going against Canada bonds. What happened? Well, we had a CPI report in the United States. That's a consumer price index, just call it the inflation report, where inflation is ticking up according to that report. It was expected to come down below 3%. It was just slightly above 3%. This is unexpected, puts the market into a bit of a tizzy there. So what else happened? Well, we continue to have great jobs reports, both in Canada and in the United States. And what you're scratching your head saying, well, wait a second. Great jobs reports is bad for the economy? Not bad for the economy, but bad for interest rates. Like the longer that inflation is over 3%, the longer that jobs are soaring, busy job reports, that punches up these bond yields. It's as simple as that. So what happens next? We're going to see mortgage rates go up. We're going to see some other factors come into play over the next month or two that will eventually start to push them back down again. But for today, they're up. And it's just as simple as that. They're up. And we're going to see higher mortgage rates for people who are renewing. Some people got a break on renewal in the last 2 or 3 weeks. Got a little bit better renewal action come their way, a little bit better rate offers. We're going to see that change. We're going to see some renewal offers in the 6s. That's too high. If you get a renewal offer that has a 6 in front of the rate, you should shop around vigorously. There's going to be a lot of rates that are still that are available in the 5% range, but you will see some of them pushed over 6. For people who are buying houses, again, if it's closing in the next 3 months, then next 2 months particularly, maybe as we think about it, we're in February, March, April, May, closings in May or very late April. You got a shot at some lower rates by then, but If you're closing next month in March and you don't have a rate lock already, like if you're just making a buy this afternoon, those rates are going to be a little higher. So that's the fact. So the overall impact, not good for anybody with mortgages or getting a mortgage. Not good for fixed rates. No change in variable. And what happens in the future? In the future, the rates will come down, because I guarantee you one thing about the longer that high rates are around. The longer that high rates are around in Canada, the economy will slow. Guaranteed. So we hang back, we wait, we see. I'll keep you informed.